Okay, so we're diving into disability insurance today.
Sounds good.
You know, you send over this chapter,
Yeah.
and it's pretty dense.
It is, yeah.
I mean, there's a lot to unpack
A
here.
lot of good stuff in there.
Yeah, a lot of good stuff. And I think our goal today should be to pull out the most important stuff for our listeners. You know,
Absolutely.
whether they are wondering about their own individual needs,
Yeah.
how disability insurance works for them.
Mm-hmm.
Maybe they're a business owner and wondering how this works in a business context,
Right.
or even, how it interfaces with, things like Social Security and workers' compensation.
Exactly, yeah. Big picture stuff.
Exactly.
And then some of the intricacies, too.
Yeah, yeah. So it can seem complicated, but at its core, it's really all about protecting your ability to earn an income.
Right.
If something happens and you
Yeah.
get sick or injured and you can't work.
Exactly. It's
Yeah.
about having that safety net, that
Yeah.
peace of mind.
Yeah, that peace of mind, that backup plan.
Mm.
It's there to catch you if you can't bring home a paycheck.
Makes sense.
Right. And as you know, the chapter covered a bunch of different types of policies.
Yeah.
We've got individual plans, we've got group plans, the kind you might get through your employer.
Mm-hmm.
And then even specialized policies for businesses.
Right.
So I think a good place to start would be with,
Yeah.
what exactly is a disability?
That's the core question, right?
Right.
Because it's not always as obvious as you might think.
Yeah. Yeah. It's not a simple yes or no.
Not at all. And as you highlighted in the chapter, how a disability is actually defined can vary a lot depending on the policy.
Yeah. That's interesting.
Yeah.
So it's not a one-size-fits-all thing.
It's really not. So let's break down some of those key definitions, okay?
Yeah.
We'll start with total disability. This is, the big one that most people think of.
All right.
And the material you shared outlined a couple of common ways this gets defined. The first is pretty straightforward. It's the inability to perform what they call the material and substantial duties of your own occupation, your specific job.
Okay. So if you just can't do the key tasks of your current job,
Right.
that would make you totally disabled under that definition.
Makes sense.
Right.
But then it gets more nuanced because some policies use a stricter definition where total disability means you can't perform the duties of your own job or any job that you could reasonably be expected to do based on your, education and experience and training.
Oh, interesting.
Yeah.
So that one's definitely more restrictive.
It is. And as you pointed out, some states actually go a step further and just adopt the definition used by the Social Security Administration, which kind of falls under this any occupation umbrella. So that's a whole other level of complexity.
Yeah. And the Social Security definition itself seemed
Yeah,
pretty detailed.
it is.
And maybe even a little hard to meet.
You're right. It can be a high bar to clear. So according to Social Security, you're considered disabled if you can't do any substantial gainful work. And this has to be due to a medical condition, something that's documented by doctors.
Okay.
And this condition has to be expected to last at least 12 months or result in death.
Wow.
So it's not just a temporary setback.
No.
Right? It has to be pretty serious and long-lasting.
Right.
And going even deeper, the Social Security website, which your chapter pulled from, they actually list 3 additional elements.
Okay.
First, you can't do the work you did before.
Mhm.
Second, you can't adjust to other work because of your medical condition.
Oh, I see.
And third, your disability has to last or be expected to last for at least a year or result in death.
So it sounds like qualifying for Social Security disability can be pretty tough.
It often is, which is why, private disability insurance can be so important.
Right. It's like an additional layer of protection
Exactly.
in case you don't meet those really stringent Social Security requirements.
Makes sense. Now, your chapter also talked about partial disability.
Yeah.
What do you make of that one?
Well, partial disability is when you can still do some of your job duties,
Mm-hmm.
but not all of them.
Right.
Or maybe you can only work part-time because of your condition. And that means, of course, you're earning less income.
Right. Your earning capacity has taken a hit.
Right.
But you're not totally out of commission.
Exactly.
So that's where partial disability benefits come in.
Right. And then there's this idea of residual disability, which builds on that concept.
Mm-hmm. And it's important to understand, residual disability pays a benefit that's proportionate to how much income you've actually lost.
Oh, that's interesting.
But there's usually a catch. That loss has to be at least 20%.
Okay.
Your chapter had a good example with this guy, Frank, who makes $5,000 a month.
Yeah, Frank.
So let's say his disability policy would pay him 70% of his income if he was totally disabled, which would be, $3,500 a month.
Okay.
But let's say he can work part-time And he's only making 40% of what he used to. So his income's dropped by 60%.
Right.
With residual disability, he wouldn't just get some standard partial benefit.
Okay.
He'd actually get 60% of that $3,500 total benefit.
Yeah.
So $2,100 a month. It's tied directly to how much his income went down.
Wow, that's really helpful.
Yeah.
It recognizes that you might not be completely unable to work, but still need significant support because your income is lower.
Right.
Then there's presumptive disability, which sounds pretty serious.
This one kicks in when you suffer a severe loss, like if you lose both arms or legs, or if you completely lose your sight or hearing or speech.
Wow.
In these cases, the insurance company basically assumes you're totally disabled, even if you could theoretically do some kind of work.
That makes sense in those situations.
Absolutely. And just to round things out, your chapter also mentioned a few other disability definitions. Concurrent disability,
Yeah.
which is when multiple medical conditions all contribute to the same disability. Delayed disability, where, say, the disability doesn't show up right after an accident, but it develops later on, maybe within a few weeks or months.
Oh, interesting.
Yeah, usually there's a time frame specified in the policy, like 20 to 90 days.
Got it.
And then there's this distinction between confined and non-confined disability, which you sometimes see in older policies,
I see.
but it's not as common nowadays.
Okay.
So what strikes you about all these different ways disability can be defined?
I think it's just how important it is to really scrutinize
Yeah.
any policy that you have or are considering.
Right?
Because disability isn't
Yeah.
just this
Cut off.
simple thing.
No.
It can mean different things in different contexts.
100%. Now that we've looked at what qualifies as a disability, let's dive into the types of coverage out there.
Yeah.
And your chapter made a really clear distinction between occupational and non-occupational coverage, which I think is super helpful.
Yeah, I agree. That was a good distinction.
So occupational coverage basically means you're protected whether your disability happens at work, at home, wherever.
Yeah, it's 24/7 protection.
Exactly. That's typically what you see with individual disability income insurance policies.
Oh.
Non-occupational coverage, on the other hand,
Yeah.
that only covers disabilities that don't happen because of your job.
So it wouldn't cover, say, a work-related injury.
Exactly. And this is often found in group plans offered through employers
Okay.
because, they're designed to work alongside workers' compensation, which is specifically for work-related injuries and illnesses.
Right. So if you get hurt on the job and have non-occupational coverage, you'd likely need to file a workers' comp claim.
That's the idea. Now let's take a closer look at individual disability income insurance, or IDI.
Okay.
What are the essential features people need to understand?
Well, as we just said, it's usually an occupational contract.
Right, offering that 24/7 coverage.
Right. So it's not limited to just what happens at work.
And your chapter pointed out that there are usually limits on how much you can receive in benefits.
Right.
They're typically tied to a percentage of your income before you became disabled,
Well,
often up to 60% of your gross income or 80% of your net income.
I see. So there's a cap on how much the policy will pay out.
There is. And that's to prevent, overinsurance,
No, interesting.
which could, discourage people from going back to work if they could.
Right.
And it helps reduce the chances of fraudulent claims.
That makes sense.
Then there's the benefit period, which is basically how long you could receive those benefits.
Okay. And how long is that usually?
Well, it really depends on the policy.
Yeah.
You've got short-term policies, which might cover you for, say, 6 months up to 2 years.
Right.
And then you've got long-term policies, which can last for 2 years or even all the way to retirement age.
Oh, wow.
And as you might expect, a longer benefit period usually means you'll pay a higher premium.
That makes sense.
You're getting more potential coverage.
Right. Then there's the elimination period,
Right. Which is basically a waiting period.
a waiting period.
Yeah, it's the time between when you become disabled and when the insurance company starts paying you benefits.
Oh, I see.
It's kind of like a deductible in health insurance, but instead of dollars, it's measured in days or weeks.
Interesting.
Right.
So you're essentially self-insuring for that initial period.
Exactly.
And that's why, I guess, a longer elimination period usually means lower premiums.
That's exactly why. You're taking on more of the initial risk.
Makes sense. The chapter also mentions something called a probationary period.
Oh, yeah.
How's that different from the elimination period?
Well, the probationary period is only at the very beginning of the policy.
Okay.
It's like a one-time waiting period, usually 15 to 60 days.
Okay.
And during that time, they usually won't cover illnesses, only accidents.
Oh, I see. So you can't buy a policy when you're already sick and expect it to cover you right away?
Exactly. It's to prevent people from, taking advantage of the system.
Right, right. And accidents are okay because they're unforeseen.
They are. Now let's talk about how those benefits are actually paid out. The chapter talked about different benefit methods.
Mm-hmm.
So there are two main approaches, percentage of earnings and flat amount.
Okay.
With percentage of earnings, as the name suggests, your benefit's calculated based on a percentage of what you were earning before you got disabled.
Okay.
And this is more common with group plans.
Gotcha.
And the nice thing is, it can adjust if your income goes up or down while you're working.
So it keeps pace with your earnings.
Exactly. Then there's the flat amount method,
Okay.
which is usually used for individual policies. And with this one, the benefit is a fixed dollar amount.
Got it.
So once it's set, it stays the same unless you buy more coverage.
I see.
So those are the two main ways benefits can be structured.
Okay. Now, what about premiums for individual policies? How do they figure out how much you'll pay?
Well, there are a lot of factors that go into it. They look at things like the benefit period, how much coverage you want, the length of your elimination period, and then they also consider you specifically, your age, your sex, your health, your income, even your occupation.
Wow, that's a lot.
It is.
They really do a deep dive.
They do. And, some jobs are just riskier than others in terms of disability.
Makes sense.
So people in those professions might pay higher premiums.
Oh, yeah, I can see that.
And they also consider whether you have other disability insurance coverage
Oh, okay.
to make sure you're not overinsured. Your chapter also talked about the difference between level premiums, which stay the same throughout the policy,
Okay.
and then age-banded or annually renewable premiums,
Okay.
which can go up as you get older.
Right, because the risk of disability increases as you age.
Precisely. Now, to assess that risk, insurance companies do something called underwriting.
Yeah.
What do you know about that?
Well, it's how they basically evaluate how risky it is to insure you. Right. And as we've talked about, your age and your occupation play a big role.
Big time.
And interestingly, the chapter mentioned that women tend to file more disability claims than men.
Yeah, statistically speaking.
So that can sometimes lead to higher premiums for women,
Right.
which is kind of a bummer.
It is what it is, unfortunately. And then you've got these risk classifications, preferred, standard, substandard,
Okay.
which basically determine your premium rate.
Okay.
And if you're classified as substandard risk, they might even exclude certain things from your coverage or shorten your benefit period.
Oh, that's not good.
Not ideal.
Mm.
So those are some of the key factors they consider when underwriting a policy.
Okay, so we've covered how they define disability, the different benefit structures, how premiums work, and how they assess risk.
Yeah.
What about the actual terms and conditions of the policies?
Yeah.
The chapter mentions some standard provisions that are typically included.
Yeah, there are a few important ones to be aware of.
Okay, let's go through that.
Okay, so one is the change of occupation provision.
Okay.
If you change jobs and start doing something more hazardous without letting the insurer know,
Yeah.
your benefits could be reduced if you get disabled because of that new, riskier job.
Oh, that makes sense.
Right. But on the flip side, if you switch to a less risky job, they might lower your premium.
Oh, that's good to know.
So it's important to keep them in the loop.
Right.
Then there's the relation of earnings to insurance clause.
Okay, what's that about?
This one's basically to prevent you from having too much disability insurance.
Oh, interesting.
So the total benefits you receive from all your policies can't be more than your actual income loss.
Okay, so it's a safeguard against getting more money from being disabled than you were making while working.
Exactly. And they figure out how much each insurer has to pay based on their proportion of your total coverage.
That makes sense.
Then there's the impairment rider.
Okay.
This lets the insurance company exclude coverage for certain pre-existing conditions.
Oh, so they can still offer you a policy, but carve out specific health issues that they won't cover.
Exactly. That's how they manage their risk.
Okay, I can see that. Now, the chapter also talked about provisions that help people get back to work,
Right.
if they're able.
Yeah. Like the rehabilitation benefit. This can help you financially if you need vocational training or other programs to prepare for a new job because your disability prevents you from doing your old job.
That's really helpful.
It is. And then there's the medical reimbursement benefit.
Okay.
This one can cover certain medical costs for injuries that don't actually result in a disability claim.
Oh, so it's for non-disabling injuries.
Exactly. It's for situations where you need medical care, but you're not actually unable to work because of it.
Okay, that's good to know. Now, when it's time to renew a policy, are you always guaranteed to be able to keep it?
Well, it depends.
Huh.
The chapter talked about guaranteed renewable and non-cancelable policies.
Yeah, those sounded important.
They are. So with a guaranteed renewable policy, the insurer has to renew your policy up to a certain age as long as you keep paying your premiums.
Okay.
But they can change the premium rates.
For everyone with that type of policy.
Exactly, for an entire class of policyholders.
I see.
Now, a non-cancelable policy is even better. They guarantee renewal and that your initial premium rate will never go up.
Wow, that sounds like the gold standard.
It kind of is, but of course, those policies are usually more expensive.
Makes sense.
And they might have stricter underwriting requirements.
Okay. Now, what about things that individual disability policies don't cover?
Ah, yes. The exclusions.
Yeah, those are important to know.
They are. Some common ones include disabilities caused by war,
Okay,
or if you intentionally injure yourself,
got it.
and then disabilities from, say, non-commercial aviation, like if you're flying a private plane. Unless you're a paying passenger on a commercial flight.
Okay.
Active military service is also often excluded. And, of course, anything illegal. If you get hurt while committing a crime, don't expect your disability policy to cover you.
Right, that makes sense. Okay, so those are the basics of an individual disability policy.
Right.
Now let's talk about those individual policy riders that the chapter went into.
Okay, the riders. These are like the add-ons.
Yeah, like optional extras you can tack onto your policy.
Exactly. And they usually cost extra, but they can provide some really valuable additional coverage.
Okay, so what are some of the most common ones?
Well, one you'll see a lot is accidental death and dismemberment, AD&D.
Okay.
This one pays a lump sum called the principal sum if you die because of an accident.
Okay.
And then there's the capital sum, which is usually a portion of the principal sum, and it's paid if you lose a limb or, your sight or hearing because of an accident.
I see.
So it's for those really serious life-altering injuries.
Makes sense. There was also the elective indemnity option.
Right, right. This one gives you the choice to get a lump sum payment. Instead of ongoing disability benefits, it's usually for specific injuries listed in the policy.
Okay.
And it can actually be a feature in some disability buyout policies too, which we'll talk about later.
Gotcha. What about the hospital confinement rider?
That one's pretty straightforward. It pays you an extra benefit for each day you're in the hospital while you're disabled and getting benefits.
Oh, okay.
And sometimes it can even waive your elimination period for those hospital days.
Oh, wow. That could be really helpful.
It can. Now, the return of premium rider.
Yeah, that one caught my eye. It sounds like you can get some of your money back.
Yeah, if you don't end up needing to use the policy.
Awesome.
Basically, if you have a good claims history for a certain period, they'll refund a percentage of the premiums you paid.
That's pretty cool.
It is. It's like a reward for staying healthy.
Right. There was a similar one called the cash surrender value rider.
Yes, and this one will return all of your premiums if you reach age 65 and haven't filed any claims.
Oh, wow. So it's like a savings plan almost.
In a way, yeah. But of course, you're giving up the protection if you need it before then.
Right, right. What about the lifetime extension rider?
This one's important for those long-term disabilities.
Okay.
So if you become disabled before a certain age, usually 65,
Mm-hmm.
this rider can extend your benefits for the rest of your life as long as you're still totally disabled.
Oh, it's huge.
It is. But if your disability starts later in life, the benefits might be reduced or stop at 65.
I see.
It really depends on the policy.
Makes sense.
Yeah,
The Social Security rider seemed really important for coordinating with government benefits.
absolutely. It's also called the Social Insurance Supplement, or SIS, and it basically kicks in if your application for Social Security disability insurance is denied or if you get less than expected,
Oh, I see.
or if the same thing happens with workers' comp.
Okay.
It's designed to fill those gaps.
That makes sense.
Then you have the additional monthly benefit rider.
Okay.
This one gives you a temporary boost to your monthly benefit, usually for the first 6 to 12 months of your disability.
Okay.
And it can be really helpful, especially while you're waiting for your Social Security disability benefits to start.
Right, because there's that 5-month waiting period with SSDI.
Exactly. Now, the guaranteed insurability rider,
Yeah, that one's about increasing your coverage in the future.
like as your income grows,
Mm-hmm.
it gives you the option to buy more coverage at certain times without having to go through medical underwriting again.
So you don't have to prove you're still healthy.
Exactly. Which can be really valuable if your income increases significantly.
Right. But the chapter said it's often a use it or lose it kind of thing.
It is, yeah. You have to buy the extra coverage within a certain time frame or you lose the option.
Got it. And lastly, there's the cost of living adjustment rider, which is all about inflation.
Right. This is so important for long-term disabilities.
Okay.
Because, inflation eats away at the value of money over time.
Right.
So this rider automatically increases your benefits each year based on changes in the consumer price index.
Oh, that's great.
Usually there's a cap on how much they can increase,
Well,
but it helps ensure that your benefits keep pace with the rising cost of living.
that makes sense. Okay, so we've covered individual policies and all those riders. Now let's talk about group disability income insurance plans.
Okay, let's shift gears to group plans.
How are those different from individual policies?
Well, first off, group plans, they got to be a natural group, meaning they're not formed just for the sake of buying insurance.
Yeah,
It's
yeah.
got to be like employees of a company
Right, right.
or members of an organization, something like that.
Gotcha.
And the premiums, they're based on the risk of the whole group,
Okay.
not individual underwriting like we talked about with individual policies.
So it's more about the overall risk of the group than the individual risk of each person.
Exactly. And employers, they can offer different group disability plans
Okay.
to different types of employees.
Like full-time versus part-time.
Yeah, exactly. Or union versus non-union employees.
Yeah.
And to avoid adverse selection, they usually have a minimum participation requirement. Oh, I see. So not just the people who think they're going to need it can sign up.
Right, that makes sense. The probationary period seemed to work differently with group plans, too.
It does. Instead of being policy-based like in individual plans,
Yeah, okay.
it's often based on your length of service with the company.
So you might have to work there for a certain amount of time before you're eligible for coverage.
Exactly.
Okay. And what about the elimination period?
The elimination period, it's usually the same for everyone in the group.
Okay.
And a lot of times it's integrated with like sick leave and short-term disability benefits.
Oh, interesting.
Yeah. So you might have a shorter period of sick leave, then a short period of short-term disability,
Okay.
and then the longer elimination period for long-term disability would kick in.
Right, that makes sense. So you have a sort of tiered system.
Exactly. Now,
Like-
the benefit periods in group plans,
Mm-hmm.
they're pretty similar to individual plans. You've
Right.
got short-term and long-term options, but the benefit amounts, those are a little different.
Okay. How so?
Well, in group plans, the benefit is usually a percentage of your wages before you got disabled,
Oh,
and it can adjust as your income changes.
oh, that's nice.
It is. And since it's a group plan, you usually don't need those guaranteed insurability riders to increase your coverage if your income goes up.
Right, it's already built in.
Exactly. One big difference that stood out in the chapter was coordination of benefits.
Yeah, what's that all about?
So group plans, they're often set up to work with other disability income sources.
Like Social Security.
Yeah, like Social Security, disability insurance, and workers' compensation.
Yeah.
The goal is to make sure the total benefits you get don't go over your pre-disability earnings.
So they all kind of work together to make sure you're not getting more than you were making before.
Precisely.
Oh, I see.
And some group plans even limit their coverage to non-occupational disabilities.
Right, because work-related injuries are usually covered by workers' comp.
Exactly. So when you're thinking about group disability insurance, it's helpful to remember that it's primarily non-occupational.
Got it. And just to recap, the two main types of group disability plans are short-term and long-term.
Right. Short-term, as the name implies, has shorter benefit periods,
Like how long?
maybe 13 to 26 weeks.
Okay.
And the benefits are paid weekly, usually 50% to 100% of your income.
Okay.
And for short-term plans, the disability definition usually focuses on your own occupation. Can you do your job or not?
Makes sense?
Long-term disability, that's for those more extended periods,
Yeah.
2 years or more, sometimes all the way to retirement.
Wow.
Benefit limits are typically 50% to 70% of your income. And a lot of long-term plans, they actually start with an own occupation definition for the first year or two,
Okay.
but then they switch to any occupation, so it gets stricter as time goes on.
Interesting. Okay, so we've got individual and group policies down.
Yeah.
Now let's move on to how disability insurance is used for businesses.
Right, right. Because it's not just about protecting individual income.
Thank
It's
you.
be crucial for business continuity, too.
Yeah, this part of the chapter was really fascinating.
It is.
So let's start with business overhead expense insurance.
Okay. BOE insurance.
What is the main purpose of that?
So BOE insurance, it's specifically designed to keep a business running if the owner becomes disabled.
Right.
It helps cover those essential operating expenses,
Like what kind of expenses?
like rent, mortgage payments, utilities, employee salaries,
Okay.
but not the owner's salary.
Right, that's important to note.
It is. BOE is not income replacement for the owner. That's what personal disability insurance is for.
Okay, so BOE is about making sure the business can keep the lights on and pay its bills
Exactly.
while the owners are covering.
And things like, leased equipment costs, those kinds of things.
Oh, yeah. So who usually buys this type of policy?
It's usually for professionals who are in private practice, self-employed people, partners in businesses, and sometimes small corporations.
Okay, so smaller businesses where the owner's absence would really disrupt things.
Exactly.
Yeah.
And the policy pays up to a certain monthly maximum, but it only reimburses for the actual expenses incurred up to that limit.
Got it. So you don't get a windfall if your actual expenses are lower than the maximum benefit.
Right. Now, disability buy.